Most people assume the rich get rich by spending less, saving, cutting costs, living below their means. That story is clean. It feels moral. It feels logical. And it's also incomplete. Because if you actually look at how wealthy Americans operate at the top end of the system, something strange appears. They don't sell assets when they need money. They don't cash out in the way most people imagine. They borrow. They borrow against the things they already own. And sometimes, they borrow even when they don't need to. That's the part most people misunderstand. Because in the financial world they live in, spending your own money is often the least efficient move you can make. And once you see why, the entire idea of wealth starts to look different. Not simpler. Stranger. Let's start where this becomes visible. Not in theory. In real life. There's a pattern that repeats quietly among high net worth individuals in the United States. A billionaire needs liquidity. A tech founder wants to fund a new venture. A real estate investor wants cash for another deal. A private equity partner wants to avoid triggering taxes. They don't go to their portfolio and sell. They go to a bank. They take a loan. And the collateral is not their salary. It's their assets. Stocks, real estate, funds, ownership stakes. To understand why this matters, you need to flip one assumption. Most people think of wealth as income. The rich think of wealth as ownership. And ownership in modern finance is not something you sell first. It is something you leverage. Now, here's the uncomfortable part. The system is designed for this behavior, not against it. To see how, we need to slow down and break it into layers, because nothing about this is accidental. It starts with a simple tax reality. In the United States and most modern economies, taxes are triggered by events. You earn income, you pay tax. You sell an asset, you pay capital gains tax. You receive dividends, you pay tax. But if your asset simply increases in value, you pay nothing. That is the first key distortion. A person holding $10 million in stock that grows to $20 million does not owe tax on that growth. Not until they sell. So what happens? A split emerges. Two financial worlds develop side by side. In one world, people earn money through wages and spend after taxes. In the other, people accumulate value inside assets and avoid selling unless absolutely necessary. And this creates a structural incentive. Do not realize gains, because realization is expensive. But life still requires cash. So where does liquidity come from? This is where borrowing enters. And this is where the logic starts to look almost circular. Instead of selling an asset worth $10 million, triggering taxes and losing ownership, a wealthy individual can borrow, say, $1 million against it. The asset stays intact. The tax event is avoided, and the cash arrives anyway. On paper, nothing has been spent. But in reality, consumption has occurred. A house is bought. A business is funded. A lifestyle is maintained. And the balance sheet remains largely untouched. This is the first uncomfortable truth. Debt, in this context, is not about lacking money. It is about avoiding friction in money. Now zoom in further, because this only works if borrowing is cheap. And for long stretches of modern financial history, it has been. Interest rates fluctuate, but in many periods, especially after 2008 and again in the low-rate environment of the 2010s, borrowing costs dropped significantly. At the same time, asset values, especially equities and real estate, rose aggressively. This creates a very specific mathematical condition. If your assets are growing faster than your borrowing costs, you can borrow indefinitely without technically losing ground. This is not speculation. It is structure. And
it explains something that looks irrational from the outside. Why someone with $500 million would take a loan instead of selling stock. Because selling means taxation now, loss of compounding base, and potential regret if the asset continues to rise. Borrowing means no immediate tax, asset continues compounding, optionality remains intact. In other words, selling is final, borrowing is reversible, and in high finance, reversibility is power. But this is only half the story, because borrowing also changes behavior in a deeper way. It changes psychology. When someone uses their own money, spending feels like depletion.
There is a visible reduction, a mental subtraction. But when someone uses borrowed money, spending feels detached. The asset that generated the loan remains untouched, so the brain registers less loss. This is subtle, but powerful, and it leads to a quiet irony. Debt can make spending feel cheaper than cash, even when it is not. Now let's introduce another layer, collateralization. At the core of this system is a simple mechanism. Banks are willing to lend against assets they can value and liquidate if needed. Stocks in major indices, blue-chip equities, prime real estate, private funds with stable valuations. The richer the asset base, the easier it becomes to borrow. This creates a feedback loop. More assets allow more borrowing. More borrowing allows more investment or consumption, which can lead to more asset growth. This is where inequality dynamics quietly accelerate, not through income, but through access to leverage. Now step back, because at this point, a contradiction appears. If borrowing is so efficient, why doesn't everyone do it? The answer is risk, but not the kind people usually think of. For most people, income is unstable. Assets are limited. Interest rates are meaningful relative to earnings. So borrowing becomes dangerous quickly. A small downturn can trigger forced liquidation. That is leverage without cushion. But at the top end of the system, cushions exist. Diversified assets, multiple income streams, access to favorable credit terms, institutional relationships. This reduces the probability of forced selling, and that stability is what unlocks aggressive borrowing strategies. So the system is not just financial, it is stratified. Now let's add another uncomfortable mechanism: step-up basis and inheritance structures. In many cases, when wealth transfers across generations, assets are revalued at the time of inheritance. This reduces capital gains exposure, which means that a significant portion of long-term wealth can circulate through generations with limited tax friction. Combine this with borrowing against assets rather than selling them, and you get a system where wealth can remain largely intact while still being used actively. This is the core paradox. Wealth is both stored and spent at the same time. Now we reach the psychological illusion. From the outside, it looks like the rich are constantly spending money. Luxury homes, private jets, business investments. But internally, much of that activity is not funded by income in the traditional sense. It is structured liquidity, debt secured by appreciating assets. Which means something important. Their lifestyle is not necessarily a drain on wealth, it is a function of it. And that creates a perception gap. Because for most people, spending reduces future capacity. For the wealthy, spending is often decoupled from asset reduction. Now let's introduce a historical shift. Over the past several decades, financial markets have become more liquid, more leveraged, and more integrated. Securities can be used as collateral more easily. Credit markets are deeper. Private lending has expanded. Real estate financing is more sophisticated. This has increased the borrowability of wealth, meaning wealth is not just what you own. It is how easily you can convert ownership into liquidity without selling. And that has quietly changed what wealth even means. At this point, we need to confront the uncomfortable math. Imagine two individuals. One has $10 million in cash. The other has $10 million in appreciating assets. The cash holder is simple. Spend money, balance decreases.
The asset holder is different. They can borrow against the asset, spend the borrowed funds, potentially never sell the asset. If the asset appreciates faster than the interest rate, net wealth can still grow even while consumption occurs. This is not theoretical optimization. It is standard practice in private banking circles. But it introduces a deeper question. If wealth can be accessed without being sold, what exactly is ownership? Because traditionally, ownership implied usage or liquidation. Now it can mean something else entirely. A collateral base, a credit engine, a financial identity that produces liquidity without depletion. And this is where the system becomes paradoxical, because it creates two realities that coexist in one reality. In one reality, wealth is visible, stable, and compounding. In another reality, wealth is actively being used to fund consumption and investment without being sold. Now zoom out, because this has macroeconomic implications. When borrowing against assets becomes widespread at the top, it increases liquidity in the system without corresponding liquidation of assets. That can amplify asset prices, which increases borrowing capacity further, which increases liquidity again. A loop forms, and loops do not remain stable forever. They either stabilize at equilibrium or accelerate until constrained by external forces.
Those constraints are usually interest rates, credit tightening, or asset devaluation events. But until those constraints appear, the system can look deceptively smooth, almost self-sustaining. Now we introduce the final layer, risk perception. From the perspective of the wealthy borrower, this system feels rational. They are not spending savings. They are optimizing balance sheets. From the outside, it can look like excessive leverage or financial abstraction. Both interpretations are partially correct, but neither captures the full mechanism, because the real driver is optionality. Selling removes future options. Borrowing preserves them. And in environments where uncertainty is high and opportunities are asymmetric, optionality is valued more than liquidity itself. So borrowing becomes not just a financial decision, but a strategic one. Now here is the tension that remains unresolved. This system depends heavily on stable or rising asset values. It depends on functioning credit markets. It depends on trust in collateral valuation. If any of these variables shift sharply, the logic collapses quickly, because leverage amplifies both gains and losses. And history has already shown what happens when these assumptions break. But in stable conditions, the system is extremely efficient, almost too efficient, which leads to the final question. If wealth can be used without being sold, if consumption can be funded without reducing principal, if taxes can be deferred indefinitely through structure, then what does spending your own money even mean anymore? Is it still the default mode of wealth, or is it becoming the least optimal one? And if that is true, then the real divide is no longer between rich and poor in terms of income. It is between those who must spend down their assets to live, and those who can turn their assets into liquidity without ever letting them go. And that gap does not close with discipline alone. It closes, or expands, based on access. Access to credit, access to collateral, access to structure. Which leaves one final thought hanging. If wealth is no longer defined by what you spend, but by what you never have to sell, then the question is no longer how much money you make. It becomes something far more unsettling. How long can a system sustain itself when its most powerful participants almost never need to cash out?